This analysis looks at one of the most important questions in today's equity market. The AI investment cycle is real, the spending is real, the infrastructure build-out is real. But the key question is not whether AI matters. The question is whether the market is now too dependent on the continuation of that spending cycle. In other words, what happens if the Capex engine eventually slows? We look at the question through 5 lenses. First, the scale of the spending. Second, the system that this spending feeds. Third, the historical signal from past Capex cycles. Fourth, the return math behind the AI build-out. And finally, what the market appears to be pricing today. The first point is straightforward. The AI Capex build is enormous. Across our AI-related universe, aggregate Capex has more than tripled in 5 years, rising from roughly $190 billion to around $645 billion. Revenues and EBITDA have also grown strongly, but not at the same pace. That is the tension. The infrastructure is being built faster than the demand currently visible in revenues. This does not mean the investment is wrong. It means the payoff needs time, and the market is already assuming that the payoff will arrive. The second point is concentration. This is not a broad-based corporate investment cycle. A small group of companies is driving most of the acceleration. The hyperscalers, Oracle, key semiconductor names, and the data center supply chain. That matters because the market is leaning on a narrow set of balance sheets. As long as those companies keep spending, the system works. But if their spending discipline changes, the impact does not stay isolated. It flows through the whole AI supply chain. This is where the cycle becomes important for the broader market. A few large balance sheets fund the spending. A group of high operating leverage beneficiaries converts that spending into revenues and earnings. And the market then capitalizes those earnings at a premium. That is why the AI cycle has mattered so much for index performance. The beneficiaries have contributed a large share of market earnings growth and a meaningful share of market returns. So the issue is not just Capex. The issue is dependency. History gives a warning. For decades, companies with the fastest Capex growth have often disappointed afterwards. The reason is intuitive. When companies invest aggressively, they need future demand to be strong enough to absorb the new capacity. Sometimes that happens. Often it does not happen fast enough. This cycle has been different so far, because the big spenders have continued to outperform. But that makes the burden of proof higher, not lower. The market is giving this cycle the benefit of the doubt. The return math is the core of the analysis. For the hyperscalers, AI can be a successful commercial investment. The required subscription economics are not impossible. Under reasonable assumptions, the monthly price needed to justify analysts' return forecasts is around $60 per paying user per month. That is plausible, but only under one condition: Capex must eventually decelerate. If Capex keeps growing in line with cloud revenue, the required price rises dramatically. And if investors expect returns to go back to last year's exceptional levels, the required price becomes unrealistic. So, the conclusion is balanced. AI monetization can work, but it works much better if spending slows. This creates the central conundrum. For the hyperscalers, slowing Capex is the path to better returns. It protects ROIC, improves cash flow, and makes the subscription math easier. But for the AI spending beneficiaries, that same slowdown is the problem. Their revenues depend on hyperscaler Capex, their earnings benefit from high operating leverage, and their valuations already assume the growth engine continues. So, what is good for the spenders may be bad for the companies they have been spending on. That is the fault line. The final question is valuation. Today, index earnings growth is supported by very high returns on equity. If the AI Capex tailwind fades and ROE normalizes, earnings growth also falls. The market does not appear to leave much room for that outcome. In our framework, the index already discounts a continuation of the optimistic scenario. If growth normalizes, the implied downside becomes meaningful. This is not a crash forecast. It is a margin of safety problem. When the market prices continuation, even normalization can feel like disappointment. The AI Capex cycle can continue, the technology can keep improving, and the long-term opportunity may still be significant. But the margin for error is thinnest, where enthusiasm is highest. The spend is real. The market depends on it. The return math works best if Capex slows. And that same slowdown would challenge the beneficiaries most exposed to the boom. This material is provided for informational purposes only, and does not constitute investment advice, an offer, or a solicitation. For access to the full PDF analysis, please contact us via direct message.